Hello, everybody, and welcome into this week's episode of the Magnify Wealth Podcast. I'm Cameron Gannon. I'm here with my co-host, Scott Gannon.
Good day, everybody.
Today on our show, we are going to be talking about one of the more, common things people bring up in the financial world here in Canada, that being RRSPs, or Registered Retirement Savings Plans. Scott, you want to introduce the listeners on what RRSPs actually are?
Yeah, sure. So RRSPs are a program implemented by the Canadian government back in 1957, and they are not an investment product. They are a program created by the government that investments and or savings can reside in. The RRSP itself is simply a registration that gives certain benefits and limitations.
So, why don't we jump right into what the benefits and the limitations to RRSPs?
Sure. So, first thing, let's talk about how they work. You have to earn active income to be awarded room to deposit money into your income reduction program. Now, I did not say tax deduction. And the reason I didn't say that, although all the media out there, mostly banks and financial institutions, will tout these as a tax deduction product. But it is an income reduction. Why? Well, tax deductions like business expenses, payroll, office expenses, rent, those are tax deductions. Why are they tax deductions? Because they don't have to be paid back. You never have to pay those back. And with an RRSP, which we're going to get into the problems and limitations of them, is just that. You will pay the tax eventually. So the benefit here for a lot of Canadians that are employed is it is a vehicle to save, and the government will help you to the tune of your tax rate, help you put that money away for long-term purposes or for retirement. So it's not necessarily the wrong thing to do for everybody, but there are some serious limitations that everyone, especially as the higher your income goes, the more you should be aware of the limitations and problems with. And problem number one is with an RRSP, you get a tax deferred, not tax free, tax deferred. Well, your income reduction, as I mentioned, as well as on the growth. So all that money grows tax free when it's in the plan. Good, that's good news. Bad news is that it is fully taxable when you spend it, whether you make money or not. So you could literally put $100, $200, $300, $500,000 over your lifetime. And at the end of that, if your advisor or yourself, you're not very good at investing, well, you could end up with less than what you put in, and it's still fully taxable, so you don't get to claim any losses.
Now, the second problem with RRSPs are the lack of control you have. You can of course decide how you want to save it, how you want to invest it, whether that's in the stock market, in like a GIC or high interest savings, that sort of thing. But you are out of control once it's in there. The stock market can do whatever it does. The interest rates could do whatever they do. And because you separated yourself from control of the money, it can't be used for collateral, and it also can't be withdrawn if something happens, whether that's an opportunity arises and you want money, or possibly an emergency happens and you need money. Either of those, you can't get access to that money without being subject to a tax bill to be able to touch it.
Yeah, and that's a great point, because if and when that happens, or if you run into opportunities are one thing, you'll definitely have missed opportunities along the way. But if an emergency happens, the last thing you're going to be thinking about, if the stock market happens, if you're in the stock market and the stock market happens to be down 30, 40, or 50%, that's going to be the last thing on your mind if you need that money and have to deal with emergencies. So you're just throwing money away. You're going to end up with taxable income that you really didn't make any money on to get taxed in the first place. So problem number 3, because of the government created program, you are exposed to the whims of the government. There are changes that you just have to accept. Why? Because this is like you say, it's a government created program. It's not something that was instituted by law or anything like that. Such as when you start spending it, what percentage you have to spend. And the percentage of the account that you are required to spend once you start to spend it, well, that could change. So what can that cause? Well, that can cause a inadvertent, what we call a double tax situation. It's not really a double tax, but it kind of is. It's just the government likes to use terms like lost benefits or clawbacks instead of the word tax. So what can happen is there's certain government programs that are income tested. And when your income is higher than a certain thresholds, then you end up getting clawed back at an additional amount. Most of them, like for instance, old age security at a certain level is 15 cents every dollar over a certain level. So what that means is if you were in a 40% tax bracket as you're spending your money, well, once you get past that threshold, until the old age security actually runs out, meaning that it's fully clawed back, you would actually be taxed at about 55%. Now they'll tell you you're still taxed at 40, but you're getting a 15% clawback. So do the math. So those are the types of things, and we'll do another podcast on those. Like we do have another one planned when it comes to government benefits, and we'll dive deeper into that at a later date. So problem number 4 is next. Do you want to tackle this one?
Yeah, sure. So problem number 4 with RRSPs are the fact that you're delaying tax until an unknown date and an unknown tax rate. So you're leaving your own financial situation up to chance, if you will. Instead of dealing in certainties, you're dealing in uncertainties.
Well, yeah, just adding risk.
Yeah, exactly. So the logic you hear when people say put your money into RRSPs is that you take a tax break at your current bracket, whether that's in the 30s, 40, 50% range. You're at your current tax rate, and they tell you you'll be in a lower tax bracket in the future. Well, there's a couple things to that. First of all, we're not doing our job properly if we tell you you're going to be making less in retirement than you are now. We want you to be able to enjoy your retirement. So we don't want you to be making a lot less money. Does that make any sense?
Well, in fact, that was over the long years, longer than you've been in this business for sure. A lot of the marketing was built around that. Go deduct your 40 or 50% tax today because you'll only be paying 25 or 30% in retirement. So the plan was to make you give you less money when you're retired, and you actually have more time to spend it. Like, what kind of plan is that?
Yeah. So
that's just assuming taxes are exactly the same.
Yeah, and that's the problem here is, okay, even if you are in that same tax bracket that you are now, well, that amount of income, the tax rates might be different. There's a lot of stuff going on in the political world right now. We're in a lot of debt as a country. Healthcare costs are through the roof. There's long-term healthcare costs that we're trying to come up with the money for. Infrastructure. There's a number of things that the costs are just rising and rising and rising. So if I were sitting here today and I was going to guess our tax is going to rise or fall in the long-term future, I would say rise, but that's the problem with doing this now is I don't know. Neither do you, neither does anyone know what the tax rates are going to be. So what you're doing by planning for a future tax bill rather than a current one is you're dealing in complete uncertainties.
Yeah, and again, this goes back to risk, right? Is if you can take the tax out of the equation, or if you can pay the tax today, is a better way to say it, and be done with it, would that not be a level of risk removed from your long-term planning? So we're going to finish with a bit of an analogy here, and this analogy is, you be the judge. So I come to you and I say, we're in business together. Here's how it's going to work. You invest the money, you take all the risk, you manage the business for years and years and years, or however long we are. You pay all the fees. When I tell you our business relationship is over, I will tell you how much ownership I have. Now, think about that for a second and say, would you go into business with me? If that were the terms of the deal, I'd be all over it if you are. Obviously, nobody would take that deal. And this is exactly what an RRSP is. The partner is the government, and the ownership portion is just the amount of tax you're going to end up paying. And that, to me, is just a risk I don't want to take. I don't know what you, but certainly not me. So, if you're looking for an additional or alternative ways to defer tax or to eliminate tax, as you've seen many times on this podcast, we do have strategies, and tax is our focus. It is the number one killer of your long-term growth, and we look for ways to avoid it forever, not to defer it, just to get rid of it. That's our plan.
Awesome. Well, thank you guys for tuning in to this week's episode of the Magnify Wealth Podcast. We'll see you here again next week. Have a good one, guys.
Thanks for tuning in to the Magnify Wealth Podcast with Scott Gannon. Remember to subscribe on YouTube or your favorite podcast platform for more insights on the infinite banking concept. Until next time, remember, immediate action is the most efficient way to achieve your goals.